They've been tightening credit marginally already, and this is just going to accelerate that. As you said, bear in mind, they're sitting on roughly $500 billion in unrealized losses on their safe treasury and agency
Right.
securities, which is constraining their capacity to lend. And then on top of this, now they've got a reserve for losses as these consumer loan delinquencies start to creep higher, to say nothing of their exposure to real estate, which is significant, both directly in terms of real estate loans, and also they own to over 2 trillion in mortgage-backed securities on top of that. So they are plenty exposed to a lot of stuff that's about to go bad.
Well, welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving into the turbulent waters of macroeconomic trends, precious metals, and the hidden risks reshaping global markets. I'm honored to introduce Stephanie Pomboy, founder of MacroMavens, whose incisive analysis and knack for spotting economic turning points have made her a trusted voice for institutional investors for the last several decades. With a proven record of calling major economic shifts from the housing bubble to looming credit crisis, Stephanie brings a razor-sharp perspective to the table. Steph, it's a privilege to have you on Metals and Miners. Welcome to the show.
The privilege is mine. I'm excited. This is going to be a lot of fun in a probably a fairly ghoulish kind of way, but we'll see.
I love your humor. Okay, so Steph, let's begin with the consumer. Walmart CFO, he recently warned that the tariffs on Chinese goods, still around 30%, neither retailers nor suppliers can fully absorb these cost increases, and that consumers should expect noticeable price hikes by this month, June. Of course, President Trump responded by telling Walmart that their profits are high enough and that they should absorb the higher costs and that they're being watched. The reality is the consumer is going to bear the weight, right? So after years of inflation, depleted savings, record high debt levels, and rising asset costs, how resilient is the American consumer at this point? Are we approaching a breaking point where the average household simply cannot absorb more price pressure? And what could this mean for the broader economy?
Wow, that's a monster question, because the consumer obviously is the whole ball of wax when it comes to the U.S. economy. And it is therefore where I spend most of my time. And so there's a lot to say about that. The first thing I would say is that I believe that the average consumer has been in recession, and has been in recession for a long time, not just the last couple of months, but probably going on 4 years now. So I really believe that the COVID stimulus gave us that sugar high. And once that started to fade out of the system, a lot of consumers were struggling to make ends meet. Obviously they're struggling because while we nerdy economists like to look at the rate of change of inflation, the fact is that they had a huge increase in their cost of living, and then it just went up at a slower pace, but it was still rising from an already incredibly unaffordable level. So the consumers have gotten no relief. And then, of course, the efforts to conquer that inflation entailed ratcheting up interest rates, which then rose their debt service, again, against a backdrop where they were getting no relief on their everyday expenses. So the things I look at suggest the consumer has been in recession basically since 2022, and that it's been masked by the high end that's been, reaping this windfall in financial assets and real estate and crypto and all these Mag 7.
Well, and also some debt relief, right? I mean, like the school loan repayment was on pause for a while, things of that nature.
No, I'm glad you brought that up. It's actually a topic I am writing about in my paper for my clients this week, because obviously now that those payments have been resumed, you're already seeing the impact on those borrowers where their credit scores are just plunging. I think the average credit score went down 100 points. And then there was a whole segment there of over 1 million student loan borrowers who saw a 200-point drop. And that obviously compromises their ability to buy a home or a car, or, to finance any big purchases, which will then feed back to the economy as spending slows further. So yes, I think the consumer has been in recession. As relates to the tariffs, this is why I view the tariff impact as more profound for U.S. businesses than the consumer. Because when you look at companies like Walmart, they've actually outperformed the market because people are being forced to shop at Walmart. People are having to trade down. So while their margins may be small, they're expanding their audience. And I think, yes, there'll be things where the price will have to go up, like bikes from China or whatever. But those increases will be offset by decreases on other prices because the consumer just can't afford to pay higher prices across the board. And it will come out of those margins as, Trump is pushing Walmart to say, look, you can take a little bit of a hit. And if Walmart refuses to take the hit and does pass the prices on to consumers and they say, look, we just can't buy this stuff, trust and believe that the Chinese exporters or whoever the ones, on the other end will find a way to reduce their prices so that they can maintain their market share. Because the fact is, when Trump put in the tariffs in his first term, both the CPI and PPI were lower 12 months later. And the reason was that China et al. Took the hit on their end. And their economies are far weaker today than they were in 2018. So I think there's a chance that they'll end up bearing a lot of the tariff. But even if it attempts to get passed through to consumers, I don't think it leads to the kind of spike we saw in inflation during COVID, because there's no money with which to monetize a broad increase in price.
So you see it as maybe being deflationary?
It could be disinflationary in the near term, because what happens is Walmart, for example, if they have to take all the hit to margins, the one thing they're not going to do as their profits shrink is hire more people. In fact, they'll probably close some locations and try to, put people on shorter hours or whatever. So you'll have it reflected in labor. The number one impact of profits is employment. That's the relationship between profits and employment is pretty much 1-to-1. So if profits are slowing, employment's going to slow, and that will have a disinflationary impact on the economy until, and we know it's coming, the Fed runs in with the fire hoses too late and overdoes it, and then all bets are off on the inflation front.
Okay, well, interesting. And I appreciate you bringing up the labor, because I actually have a question there. There's a University of Michigan chart which illustrates a rapid and historically significant spike in consumer unemployment expectations.
Yeah.
It's the quickest rise in the data series and the fourth such rising instance since 1998. Considering that each of the prior three spikes of this magnitude were followed by actual increases in unemployment, do you expect this cycle to be no different than past cycles and there to be a real world catch up in unemployment to these expectations that they have?
I feel like you must have a camera and you're looking over my shoulder, because that's the cover chart of my commentary to clients today. And it was reinforced with the consumer confidence report last week, that same confidence report that rebounded and everyone got so excited. Look, the biggest increase in consumer confidence. The one component that continued to go down was the outlook for jobs. And that has the strongest correlation with actual consumer spending of any component of confidence, whether it's your expectations, your income expectations, whatever, your retirement expectations. Jobs outlook has the strongest correlation with actual spending. So this is a very ominous development.
So if they're pulling, so are you seeing basically a retrenchment in spending? And if they're retrenching in spending, then there's going to be real world consequences down the road in terms of job loss.
Yeah, it's almost like a self-fulfilling prophecy, because the consumers are pulling back because they anticipate that the employment market is going to deteriorate. And in so doing, they are creating the necessary, groundwork for employment to deteriorate by slowing their spending and crimping profits, et cetera, et cetera.
Is there a time frame that's typically associated with a retrenchment to an actual seeing in the data of job loss?
Well, it's interesting because that overlay that I've done, and you're probably referring to when you look at the unemployment rate versus the expectations, it looks almost coincident. It looks like we should be starting to do that parabolic move higher on the unemployment rate. And last Thursday, I mean, I hate to get that micro about it, but we did get an increase in the unemployment claims that was a lot stronger, a lot more than people anticipated. And the continuing claims number, which measures how many people are still collecting or ongoing on unemployment, hit its highest level since COVID. So that we're already making real progress, if you could use that word, toward a significant reset in the labor markets.
So the data is starting to show, it's starting to reveal what they were fearful about.
Yeah.
Right. The average, I think, going back to the 1940s, 50s, for every recession, for every job loss timeframe, is about 3.6 on average increase in the unemployment rate. Yeah. 3.6, 3.8%, somewhere in that range. We'll call that, in Stanley Druckenmiller's terms, the garden variety recession. Are you expecting a 3.6 to 3.8% uptick in unemployment this time around, or are you expecting something more substantial?
Well, oh gosh, it's a really tricky one, because a lot will depend on whether this tax bill gets through. Whether, if we can sustain the tax cuts, that will be a major positive for the corporate sector, because right now they're under this cloud of uncertainty about the tariffs. And if they at least know that their tax liability isn't going to change, that could be a huge, weight lifted. So let's assume it gets through. I guess, it's hard. To me, it really comes down to what happens to interest rates here. The higher interest rates go, the more dire I get about the outlook for the economy, obviously. So, I hate to cop out on this, but the question will be, how quickly does the Fed come in and institute some kind of yield curve control like they were doing in Japan to prevent the high end of the curve to move even higher still. So I think that's coming. The question is, will it come soon enough to prevent the 3.5% percentage point spike in the unemployment rate, or where does it come along that process?
Well, normally they're too late. So
yes, so I think that's a pretty good guess. They'll be too late.
But to your point, it's fair. There's variables there that are unpredictable. All right, but let's go back to the consumer, Steph. We're now seeing serious delinquencies in credit card and auto loan debt rising to levels not seen since the 2008 great financial crisis, with about 7% of credit card debt and about 5% of auto loans 90 plus days delinquent in the first quarter. On top of that, the Trump administration recently halted the FHA loss mitigation or foreclosure prevention program that can impact several million mortgage holders who are currently delinquent and behind on their payments, and the COVID era student loan a repayment pause that you mentioned. That's all restarting. So at what point do these rising defaults across the board become a systemic concern for the economy?
I mean, I'm sitting here tapping my fingers, and I have been for a long time. You'd think the highest delinquency rates since the back end of COVID, or even the global financial crisis in the case of credit cards, would be opening some eyes. And yet you get Jamie Dimon and his peers talking about the strength of the consumer. So, I mean, it's frustrating beyond belief, but I do think that this resumption of the student loan payments could be a precipitating event. And bear in mind that at the same time that is starting to kick in and have an impact on credit scores. I mean, think about it. If you were a student loan borrower and you also have a credit card and a mortgage, and you didn't have to make your student loan payments, you were able to stay current on your credit card and your mortgage. Now, as you have to make your student loan payments with the same amount of money, mind you, you've got to figure out, you got to prioritize. What am I going to pay first? How much now maybe I'll only make the minimum payment on my credit card, or maybe I won't even do that. So you're going to see more pressure on delinquency rates of every type over the next few months. But then there's one more wrinkle, and that is buy now, pay later,
Right.
or buy now, pay never, as the case may be. I know that the Dave Ramsey's, financial advisor people would have told people, don't use buy now, pay later because you can't develop a credit score since these loans aren't tracked by the credit agencies. They're not reported. Well, starting April 1st, these buy now, pay later firms like Affirm and what's the other one, Klarna, Afterpay, they're starting to report to the credit agencies. And my view is that is not a blessing, it's a curse, because these people who have been using buy now, pay later to buy their groceries aren't doing it because they plan to pay the money back. They're figuring, well, what are they going to do? They can't repossess my lasagna, So that's going to hit consumption for that low end consumer, because now suddenly they can't borrow without consequence. But it may also, for those who do care about developing a credit score, again, add to that pressure on delinquencies of other types of credit, as well as they're trying to service more debt with the same amount of income.
So credit ratings are going down on average in aggregate because of all the factors that you've mentioned. That's a no-brainer, which makes it harder to obtain credit in an environment where they're already strapped for cash and they already are tapped out in many of their forms of credit.
Right.
And they have a new $500 to $600 a month payment for student loans kicking in. Is this a recipe for disaster?
Yeah, I think it's a real problem. And then you layer on top of that, I hate to just, pile on here, but it looks like we're starting to see a turn in the housing market. So the timing for that couldn't possibly be worse. We've had this environment where the housing market's been in this unique kind of purgatory because the institutional buyers bought up all these properties. And essentially, you've had no price discovery because no one can afford a mortgage. So there's really no transactions. So you've got this kind of suspended animation, and there's now evidence that these institutional players are starting to dispose quietly of some of their properties. And if that gains momentum and you see pressure on prices, for sure, it will increase affordability for people who have been waiting on the sidelines, but at the expense of, the home equity for a lot of people who are sitting there counting on that as sort of a nest egg. And you have seen things like the home equity borrowing that has been a source of money as well in this type.
Yeah, that's what I was just going to say to you, is as a source of an ATM,
right,
that ATM will dry up if the banks are paying attention, which they are, to that because of their other challenges on their balance sheets. Then they're going to make it really difficult on the consumer who's having in aggregate declining credit scores to even tap their equity. Yeah,
well, they've been tightening credit marginally already, and this is just going to accelerate that. As you said, bear in mind, they're sitting on roughly $500 billion in unrealized losses on their safe Treasury and agency securities, which is constraining their capacity to lend. And then on top of this, now they've got a reserve for losses as these consumer loan delinquencies start to creep higher, to say nothing of their exposure to real estate, which is significant, both directly in terms of real estate loans, and also they own to over $2 trillion in mortgage-backed securities on top of that. So they are plenty exposed to a lot of stuff that's about to go bad.
Well, let's layer on one more thing here for the banks. Okay, Steph. The SLR, the supplementary leverage ratio, it's a regulatory requirement that mandates banks to hold a minimum amount of capital relative to their total assets, right? It's designed to ensure that the banks have enough capital to absorb losses during financial stress. So here we're talking about all of this stress that they have. They already have mark-to-market losses from what they've took on during the COVID era.
Right.
And now Treasury Secretary Scott Bessent He recently announced that the Treasury plans to reduce the SLR for banks this summer, thereby allowing them to hold less capital against low-risk assets like Treasuries. He hopes it's going to inject more liquidity into the Treasury market, boost lending, reduce upward pressure on long-term borrowing rates. It's a move that's going to mark a retreat from the key change made following the 2008 great financial crisis. But it does feel like strange timing for all that we've just been discussing. What are the anticipated impacts of this policy change? It seems to me that there's going to be increased risk-taking behavior by the banks, and is this going to turn out to be inflationary?
I think I'm cynical enough to think there's really only one rationale for this move by the Treasury, and that is to create demand for Treasury debt, because Scott Bessent has said since day one and instructed Trump, the stock market isn't the barometer of your success or failure. The 10-year yield is your barometer of success or failure. And they need, and Bessent understands, they need long rates to come down, because this economy, not just the government, but the entire U.S. economy is so levered that we can't handle the truth of rates where they are. I mean, look at the corporate sector. They've been doing these extend and pretend games ever since the Fed started raising rates back in 23. So this has been going on, and we just need to control the long end of the yield curve. And I think Scott Bessent is finding it a little challenging, because Yellen had financed our entire deficits with T-bills, so as to kind of prevent any rise in the long end. And he railed against that as being financially irresponsible, which it was. However, he's done nothing to change that since he became Treasury Secretary, because I think he recognizes it's a lot harder at this point to figure out how you're going to finance $2 trillion deficits without sending the long end of the bond of the yield curve higher. So this SLR, I think, is like a gimmick to try to create some demand for treasuries among the banks. The interesting thing is it flies completely in the face of everything that he suggested they're trying to achieve, which is to privatize the economy. Well, if you're trying to privatize the economy, why are you encouraging banks to lend to the government rather than the private sector? It makes no sense. So between that, and we can get into this if you want to, I'm the last person to be knowledgeable on the topic, this crypto bill that's going through Congress, the Genius Act, is, I think, clearly an attempt to create demand for treasuries. It's not crypto, it's a stable coin. And the idea, I guess, is to create a stable coin reserve that would then be recycled in T-bills. It would basically be like a de facto money market fund that would buy T-bills. So you'd create a demand for short paper via this Genius Act, and you maybe create a demand for long-dated treasuries via the SLR tweak. But I think it's all just Band-Aids to try to keep interest rates under control.
So let's go a little bit deeper on this interest rate issue. There's obviously been a surge on the long end. The 10-year spiked from 3.59 in September of 2004 to now around 4.4%. I don't know what it is this morning, and the 30-year surpassed 5%. There are some analysts out there that are asserting that this is not a policy failure, but a deliberate playbook designed to attract global capital for the massive $9 trillion debt rollover in the second half of this year. How credible is the theory that the U.S. is intentionally orchestrating global financial stress to force investment back into treasuries?
Well, if they're trying to create a flight to risk into treasuries, they're certainly failing miserably, I would say. No, I mean, I see it quite differently. I hadn't heard that as an argument, but it sounds like the classic, let's work backward from the conclusion that we prefer to create a storyline that, might justify it. But it seems to me like it's the exact opposite. You see capital fleeing the United States. And why wouldn't it? Because in theory, what the administration is trying to orchestrate, and I think has been underway long before Trump came into office, is this shift away from globalization toward a more inward, I call it isolationism. Some people call it multipolar versus unipolar, whatever phraseology you want to use. But if the US is no longer going to be the epicenter for global trade, then why does the US financial market have to be the epicenter of the global marketplace? It's basically they were sending us their goods, we were giving them our dollars, and they were recycling their dollars back into our markets, be it treasuries or equities or whatever. And that game is now ending. So the idea that they're kind of in some last gasp trying to attract marginal credit is kind of laughable. It's like at the end of the day, you're shooing everyone away. We're putting up barriers to entry. And again, this has been going on for a while. So, this is just, Trump has hit the accelerator on something that was already very much in train. But he's done that. He's hit the accelerator. And I don't see how this attracts foreign capital. Quite the contrary.
Yeah, it's a good point. So, Steph, I'm sure you heard that Treasury Secretary Bessent, he wants to have a new policy directive since Doge didn't work. We weren't able to save the $2 trillion. Congress is not even willing to take anything up. So now we're going to run the economy hot, right, by accelerating growth beyond the rate of debt accumulation as a strategy to reduce the debt to GDP and et cetera. What are the anticipated ripple effects of this run it hot approach on the economy and the markets and even on precious metals?
Well, I don't know how you run this economy hot, because if you do ramp up growth, you're going to ramp up interest rates. You can't have massive acceleration in growth without interest rates moving up unless you get some kind of a collapse in inflation. And it's hard to imagine how you get a collapse in inflation while you're accelerating growth. So I don't understand the framework in which we accelerate GDP and long rates stay where they are. But we'll see. I think the one thing I can say for sure is that we can't afford a recession. And I think that's what Bessent's well aware of, is that if we have a recession, the savings that Doge was able to find will get, it would be a rounding error on the increase in the deficit. So I get the idea that the last thing we need is growth to slow. We need growth to accelerate, and the tax cuts are designed to do that. And I think what he's saying basically is if we can get the economy to grow enough, the concerns about our fiscal outlook will dissipate, and that will help provide the framework for interest rates to come lower. But how much? What are we talking about? Do you see an environment where growth goes to 4% and the 10-year yield goes to 2%? I mean, I can't imagine that. That would be phenomenal, but that sounds like the land of gumdrops and roses to me.
All right. So basically, we don't achieve the cost savings. We don't achieve this run it hot scenario. So it's just more of the same of what we've been doing.
Yeah.
What's the ramifications of that?
Well,
is it a death by 1,000 cuts kind of a scenario?
So my sense is obviously the federal government can sustain this because they have the power of taxation and access to a printing press. It's the private sector that can't withstand rolling debt at higher rates like this. And we alluded to it earlier, but one of my main focuses has been the corporate sector and the massive amount of debt that they have taken on post the global financial crisis, but even more aggressively post-COVID. And that debt post-COVID was taken out at rates that we'd never seen in a lifetime. We had junk-rated borrowers, junk-rated companies borrowing at 4%. I mean, that's where the 10-year Treasury yield is today, as you just said. So those rates now are 8%. So for companies that were borrowing at 4% and have to roll that paper at 8%, it's just, they can't exist in that environment. It's like the student loan people we were talking about earlier. Like they just can't do that. So what's been happening behind the scenes with a lot of these non-publicly traded entities is there have been these negotiations and the restructuring of debt at this whole extend and pretend game. But you can only do that for so long. At some point, the creditors are going to say, hey, I need some interest income. I've gone 3 years here without collecting dime one, and I've got my own cash flow issues to deal with. And you're seeing this play out. I mean, I don't want to get too far off on a tangent, but with the the university endowments,
Yeah.
who have been massively exposed to these highly illiquid assets, they're collecting zero income. And so they've had to go out and borrow money, $53 billion Harvard endowment, and they got to go out and pedal for money so that they can manage their operating expenses, because they've got all their money with these private equity firms that are not throwing off any income. So it's just not sustainable for the private sector to have rates at this level. And they've been betting month after month, year after year, that rates are going to come down, that the Fed's going to cut rates and they'll be able to refinance lower and breathe easier. And TikTok, every day that goes by, another company goes belly up. I mean, look at the parade of corporate bankruptcies we've seen, and I don't see that abating.
That's the highest since the great financial crisis, isn't it?
Yes.
Yeah.
Yep.
So we have this increasing global trend of nations facing unsustainable deficits, a lack of political will to cut spending, and the resulting expropriation of wealth through inflation or future tax increases. The concept of holding outside money rather than inside money, it seems to be gaining urgency and traction everywhere. In your view, is gold the ultimate outside money? And is that why gold is on the march higher since early last year?
Yeah, I mean, I guess I think of gold as, obviously the ultimate form of money. It cannot be debased. And as you alluded to there, it's not just the United States that is going to have to debase its currency. It's every major industrial nation. In other words, every major reserve currency. So this isn't a question about the dollar. It's a question about fiat money more broadly. And again, I've thought for a long time that we are going to come out of this with a new monetary regime. Whatever that looks like, I don't know. But I know that gold will get me from here to there while preserving my purchasing power. And I have much less confidence that things like crypto will accomplish that. But gold to me is, it's the ultimate arbiter of monetary integrity. And we're in an environment where the monetary integrity globally is pretty limited, and it's about to get even more promiscuous, let's say.
And, as you put, from getting from here to there, but we don't know how long that here to there, that dash is. I mean, that dash could be a decade, 2 decades. So if I don't want to put words in your mouth, but it sounds like, gold broke out in March of last year. It's up 65% or more since it broke out. This trend of purchasing power debasement, et cetera, is going to continue. So do you expect this trend higher in gold to continue indefinitely until this new monetary regime is put in place?
Yeah, I mean, I think that what we've seen so far is most of the move has been driven by foreign central banks diversifying out of dollars into gold, led primarily by the BRICS plus countries. You've seen until recently precious little Western participation in this, which to me is exciting because it suggests we've got that much farther to go when these people finally wake up and realize what's happening. And then you'll get into sort of a frenzied move higher. So, I don't need to be a hero and forecast gold going to 10,000.
Right.
Do I think it could? Absolutely. But, I just sleep very well at night. I know that I get a lot of flack, I'll use that polite word, for having missed the move in the stock market. And I go back and look and I say, well, yeah, let's see what stocks are up 11, gold's up 30. I really missed out on that one. But as you said at the very beginning, it's just, you've been trained not to look at gold. And that if you do look at gold, then you're anti the whole entrepreneurial patriot. You're not a patriot, you're a negative Nancy, you're down, you're against the dollar. It's all those things. And in reality, all we're trying to do is be smart and preserve our hard-earned capital for what is clearly coming down the pike.
I want to welcome everyone who's tuning into this fantastic interview with Steph Pomboy, founder of MacroMavens. This has been an awesome and incredible discussion. Before we wrap up here with our final set of questions for Steph, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. It's also the title of the report. Consider upgrading for access to premium content, but even without premium, there's free content daily. So visit metalsandminers.substack.com to join us and explore. And thanks again for watching this interview. Now, I'm positive that you've been enjoying this back and forth conversation that I've been having with Steph as much as I have. Please let her know. Hit that like and subscribe button and leave a comment below the video. All right, Steph, I mentioned off camera that we're going to finish off our discussion with what I call as a lightning round. I'm just going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 or 2 sentences as to why you take the position. We're going to roll through a bunch of assets here. It is a lightning round.
Okay.
All right. If you're not following the asset, it's no problem. Just say I'm not following.
Okay.
All right. So right now, on a scale of 1 to 100, is gold a buy or a sell, and why?
I would put it at a 90. And okay. I would say it's just, as we just talked about, even though it's run pretty far, I think it's got so much fun. It's just barely getting started. And we haven't begun to see the race to the bottom as global central banks kick off the inevitable currency debasement. So buckle up, folks. There's so much more to go.
Okay. Gold miners, 1 to 100, and why?
Well, that I'd put at 100.
Okay.
They have a lot of catch up to do with bullion. And they're just insanely depressed relative, historically relative to the bullion. So I'm actually trying to overweight the miners versus the bullion for the next leg, because I think you'll get an enormous bang for your buck doing that.
Some would say they're flush with all that cash they're printing by digging in the ground. All right, 1 to 100, physical silver.
I am not knowledgeable about silver. I would say that my inclination would be to be extremely bullish, because from what I understand, the shortage of physical is even more profound in silver than it is in gold. It doesn't have the reserve asset allure that gold does, but that doesn't mean it shouldn't participate in an environment where I think paper assets are not to be held. Anything hard asset, especially precious metal related, I would be bullish on. So I'll just cop out and call it a 70.
Okay. All right. I'm going to then stay away from the silver miners, and I'm going to move over to copper.
Okay. Copper is a little more tricky, because Dr. Copper is the single best economic indicator. If you think we're going into a global slowdown, that could be a problem for copper. Although on the other side of it, again, you're going to have this shift from paper to hard assets that should inure to the benefit of commodities in general. So if you were to ask me on a relative basis whether I would own copper relative to other commodities, probably not. But if I would own it relative to anything paper, absolutely.
All right. I appreciate that answer. Uranium, 1 to 100.
Yes. Let's put that in a 90.
Okay.
Just, nuclear, all of it. Again, hard assets versus paper. Let's go. Uranium.
Do you make a distinction between the physical metal and the uranium miners?
No, I don't have a position, and I'm not knowledgeable enough. So I would probably leave it to Sprott or some other big, I would do an ETF and not try to be a genius, because I have a day job that doesn't relate to that at all.
Okay, let's move on to oil. 1 to 100, and why?
Wow. Well, again, strategic resource, something that central banks can accumulate alongside gold, and they can stockpile alongside gold. So I would certainly not be bearish. Again, it has the copper problem, though, where as we get into a global slowdown, demand for oil is going to slow, but I think it would be limited to the downside. So, my view, oil's at $63 a barrel this morning. I think we probably 60 will be is pretty much the floor for us. And, maybe we go to 70. I see it kind of in a $10 range. I'm not like seeing it going to 150, but I don't see it going lower than it is right now either.
Included in that floor that you're talking about, do you see the added demand on the need to fill up the SPR to refill that?
Yeah, I think that is definitely would be a supportive of demand, and one of many countries that would take the opportunity to do that as the price came down. That's why I think you're limited to the downside, because as prices go lower, everyone's going to seize the opportunity to stockpile.
So there's many who think, well, we're going to go back down to 20 or 30 like we did during COVID, because if we have a massive slowdown, but we might have a massive slowdown, but not ever get down that low because of the SPR needs.
Agreed. Plus, look at what's happened so far. Trump campaigned on drill, baby, drill, and brokering a peace in the Ukraine and the Middle East. And drill, baby, drill. He's already opened everything up and we're pumping. And here we are. We're still at $63 a barrel. The peace obviously is looking harder to come by. But then yesterday you had OPEC Plus increase production, and oil is up today. So yeah. I
think it was like 400,000 barrels or something. It was pretty large.
Exactly. Yeah. So I cannot get bearish on oil. I think there's a floor under it. I just also can't see it going significantly higher because, we're going to seize every opportunity to expand production. And obviously OPEC is right there with us. So
there's a lot of spare capacity opportunity there. Yeah. Okay. So let's move to the NASDAQ, 1 to 100 and why?
1. Can I go negative?
If you want.
Bubble. I don't know. This idea that we've reached a new era and all this disruptive technology, it all sounds very reminiscent of the dot-com bubble in 2000. I have no doubt that artificial intelligence is important and it'll be part of our lives going forward in some mode or fashion and probably help certain businesses. But I don't see it as justifying valuations of this extreme.
Do you see it as the funding for the rotation that you're expecting to come from financialized assets over to real?
Maybe, although I think most of the people who are participating in those NASDAQ stocks are probably going to see their wealth destroyed. So I don't anticipate them running to gold. Their thought process isn't nimble enough that they'll get out of that and see gold. It's like the antithesis. It's sort of like asking if a born-again Christian will become an atheist tomorrow. I don't see that happening.
Fair enough. That's a good point. All right. The S&P 500, do you just make a distinction between the NASDAQ and the S&P 500?
S&P obviously is a higher quality basket of stocks, and I'd be a little less bearish on that. But again, the valuation is just nosebleed.
So what if you had to say, if you called the NASDAQ a 1, what would you call the S&P 500?
A 10.
A 10. Okay. All right. Let's move on to treasuries, short-term treasuries, 1 to 100.
I guess I'll call it a 50. I'm fairly neutral on the short.
You like to store some money there for optionality in the event we have a okay.
But I don't see it going significantly in one direction or the other. So.
All right, long-term treasuries.
Again, I guess I'd probably put it a little lower, maybe at a 40. I think there's a risk that long rates move up before the economy tanks, and then they try to come down, but can't come down because of the deficit math that we just went through earlier. So I think sort of like oil, the downside in yield is fairly limited here.
Okay. On a scale of 1 to 10, with each representing a percentage, where do you see inflation ending 2025? Using the government figures. So I think we're at maybe 2.8% today or something.
Yeah, 2.4 or something.
Do you see it higher?
Uh, I'm going to cop at it and say it'll probably be somewhere near where it is right now. Again, because I think the economy will slow and that'll put some downward pressure. But then you have all the stuff people can't live without that will continue to move up in price. So
Okay.
feel like
1 to 10, 10 being the highest probability that we're headed into a recession by the end of this year.
I'm going to put that. Well, I happen to think we're already in recession. So can I just say 10?
Yeah, absolutely. If we are, then yeah. All right. Now, the 60-40 portfolio that everyone has talked about for generations is pretty much dead in the water. And it's been changing in the minds of maybe some front runners, not yet the general population, but definitely in the minds of those who are, paying attention to not just the markets, and to the metals, but also to the math. So it seems to be changing radically. If you were to include all various asset classes, what would be your desired portfolio allocation if you weren't going to do 60-40?
Well, that's a tricky one because I have to impose my age and my lifestyle and whatever on everybody else, so
that's fair.
Okay.
That's fair.
And I guess, also I think the situation we're getting into is unique. So right now I happen to be, 80% hard assets and 20% cash. So that's not a portfolio model for the long term. It's my portfolio asset allocation going through this transition phase until we arrive at whatever the next monetary framework is going to be, at which point maybe we go back to a 60-40 type of portfolio. But in that transition phase, I would be massive. You could be 100% hard assets versus paper. But
yeah, I appreciate your perspective, Steph. I really do. So would you share a key takeaway that you'd like viewers to keep in mind about today's economic market monetary situation, and then let everybody know where they can learn more about your work and how they can connect with you?
Okay. I think that the key thing, again, is to be able, from my standpoint, is to be able to step back and have a little perspective rather than getting ping-ponged back and forth with all these headlines each day about tariffs and trade bills and whatnot. And from a big picture framework, we're clearly at the end of the investment environment that we've all come to know for our entire lifetimes. And that has been this era of global trade and global financial flows that inured to the benefit of the dollar as the reserve currency and had all of our assets really held primary as a result of that. And we're now shifting away from that framework. So I would think you would be open-minded about investing outside the United States if you're going to have equity exposure, and think bigger about the world, because the U.S. is no longer going to be the epicenter. I mean, it will continue to be the epicenter for us, but in terms of global financial flows, not so much. So that would be sort of, I don't know how helpful that is as a broad takeaway, but just a little perspective is helpful. And you can find out about me at MacroMavens.com and learn about my service. I do have a retail service that you can subscribe to. And then you can find me on Twitter at @Pomboy, although I'm not very good about tweeting. You'll get the occasional snarky tweet. But hey, why not?
Well, and folks could also find you sometimes on Fox Business or CNBC, right? Yeah. And then you...
Yeah, Fox Business. CNBC is much too much NASDAQ oriented to have me on there.
Okay.
But Fox Business. And then I do a bi-weekly conversation with Adam Taggart on his Thoughtful Money YouTube channel. And who knows, maybe if I didn't completely make a fool out of myself, I'll get to come back and talk to you again, Gary.
Well, I would absolutely love to have you back on. Are you kidding me? No, I'm going to put all that information up on the screen. It'll be in the description area so people can just link right through. If you're not following Steph, you really need to. She's a wealth of information, and she's got a fabulous sense of humor. I love it. Well, Steph, thank you so much for coming on to Metals and Miners, for being so generous with your time and your analysis and your ideas. It's been awesome to spend the time together. I look forward to having you back on. I really do, sometime soon. Thanks for being here. And everybody else, thanks for watching.
Thanks, Gary.
I want to welcome everyone who's tuning in to this fantastic interview with Steph Pomboy, founder of MacroMavens. This has been an awesome and incredible discussion. Before we wrap up here with our final set of questions for Steph, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. It's also the title of the report.